The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
September defies market expectations, but tees up trepidation for the months to come. Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld. Romain Bostic is on assignment, but he will be back. And while we wait, let's get a check on markets as we count down to the closing bell. You can see the S&P 500 trying to limp to the end of the month, of the quarter, higher by just about 0.1%. We'll see if that can hold for the next hour. Meanwhile, the Nasdaq 100 fighting to stay in the green, maybe not doing too great of a job, but we know it's been a pretty good month. Meanwhile, you check in on the bond market. I'm going to go ahead and call that unchanged on the 10-year Treasury yield, sitting at 4.15%, and the VIX trading with a 16 handle, down a little bit, but still elevated from where we've been. As I mentioned, heading into September, it really did look like the risk-reward setup was favoring a pullback in both stocks and bonds. That's what history suggested. That's what seasonality was supposed to bring. It didn't happen. The S&P, Dow, and Russell locking in a fifth straight month of gains, while Bloomberg's U.S. Treasury Total Return Index logs its sixth monthly gain in 9. But leadership has been narrow. In September, more than a fifth of the S&P 500's point move was attributable to the weight of Apple alone. Throw in Tesla, Nvidia, Alphabet, and Broadcom, and those 5 stocks accounted for 80% of the upside in the S&P 500. But a renewed cycle of interest rate cuts could force broader, more cyclical stock leadership, according to Bloomberg intelligence strategist Michael Casper. That's still an if. Fed Vice Chair Philip Jefferson warning that a softening in the labor market at the same time as inflation pressure increases really complicates the path for monetary policy, and a shutdown of the government that may disrupt the collection and reporting of economic data isn't exactly helping matters either.
While inflation is likely to remain elevated into next year, I expect it'll resume its gradual return to target over the medium term. That outlook is similar to the median forecast in the September SEP, which is the summary of economic projections, but it's a highly uncertain environment, and in that context, I don't rule out scenarios that could feature higher and more persistent inflation, could feature more adverse labor market developments, or both.
Let's kick things off now with Paul Christopher. He is head of global investment strategy at the Wells Fargo Investment Institute. Paul, it's great to have you with us. There's a lot to sort through, a lot to put together here. Let's start with what is most immediate when it comes to the timeline. That's that potential government shutdown, the deadline at midnight tonight. The handicappers would say that it looks like we are headed into a shutdown. What does that mean for markets, especially when we're at a juncture where we might not actually get those BLS jobs data figures on Friday?
Yeah, thanks. Great to be back. And the real important thing for investors to remember about this prospective shutdown, we also agree that it's very likely to happen, is that it really doesn't change anything fundamental in the economy or in our projection for earnings of the stock market next year. But it could introduce some temporary volatility, and we think there might be some opportunities in that.
We'll talk about those opportunities because that's certainly an optimistic bent that I haven't heard much of so far this week.
Yeah, that's right. Kind of a lot of talk about the shutdown, and you were talking earlier about seasonality. Yeah, we got through September with gains in the market, but volumes have been kind of on the light side, and that does leave the market vulnerable to the kind of pullback we saw last week. Just a very mild 1.3%, but it wouldn't take much to generate something like that or a little bit more once again.
So it sounds like you're saying a pullback would be a buying opportunity. Does that apply evenly here? Are there certain sectors, certain areas of this market where if you saw a dip, it's worth buying?
Yeah, we agree that there are some sectors that are worth buying. And again, trying to look through the noise of the shutdown and into fundamentals that we think have more staying power over the next 12 to 15 months. Those sectors that we like in the large caps would include financials. We do expect the Fed to cut rates. That means deposit costs for banks falling, but long-term rates staying the same or going up a little bit. That means interest rates on loans going up. So we think financials, that's our most favorable sector right now. So trying to play that actual trend that we're seeing in the markets. And then there's the AI trend, where we've been favorable on information technology for much of this year after the pullback. And now we've added industrials and utilities. So that's sort of the data center play around artificial intelligence. We think there's some good buying opportunities there, especially if we get some sort of mild pullback associated with the government shutdown or some other little, interruption in the market.
It's interesting to hear you tie those three basically together. I'm taking a look at your notes. Like you mentioned, you call out technology, utilities, and industrials. That's, of course, an AI trifecta here. So it sounds like you see more steam ahead when it comes to the build-out. For some investors in the market, they've moved beyond the build-out. Now they're looking at sort of the application layer. But when it comes to your timeline, it sounds like you're still there.
Yeah, there's still a lot of capital expenditure that we think is in the pipeline, not just for this year, but much more than we expected earlier this year to be in place for 2026. That has really ramped up, and that's going to give firms quite a bit of momentum going forward. I think also about the tax changes that were approved back on July the 4th. Those changes give firms extra incentive to install a capital expenditure or capital equipment and to build out new structures. Their depreciation advantages as well. We think that is another tailwind for AI CapEx spending into 2026.
Something I always wonder about when I'm thinking about these just ginormous CapEx numbers that we're getting from some of the Magnificent Seven is how insulated that is from what we're talking about when it comes to the Federal Reserve. All of this uncertainty as to how meaningful this rate cutting cycle might be. How much does that actually matter for the daisy chain of spending that you're talking about here?
In terms of Fed rate cuts, probably not that much. They're not really borrowing the majority of the funds for this kind of expansion. They're still seeing equity money coming in. At some point in the future, debt will become more of an issue. That's not the case right now. But you made another point earlier, which is that we expect the market to broaden out, and interest rates lower could help a wide range of companies, perhaps even small caps as well as large caps. So we are looking for the Fed to help us out here. But again, there are going to be some little bits of headwinds and some turbulence, let's call it, going forward, whether it's the government shutdown or the slowing economy that we expect into the first quarter of next year, or even tariffs, which are going to make more of a mark in terms of consumer price inflation in the months ahead. Again, nothing that upsets the fundamental story we see for large caps going forward, but once we get to 26 and some of those headwinds subside, and then we see some of those secular trends like the tax cuts, the deregulation, right? Going forward, we do think that you're going to see a broadening in large caps.
Well, I want to talk a little bit about small caps because my mind is always there. And we've seen so many false dawns in this space, Paul, when it comes to price performance. You take a look at the ETF flows. I mean, some of the small cap ETFs have seen an absolute exodus this year. It seems like it's so hard to attract a sustainable bid when it comes to that area of the market. And listening to you talk, I mean, is it that rate cuts are a must-have when it comes to that broadening out to that size of company that we're talking about?
Yeah, let's say that it's sort of in logical terms, lower interest rates are necessary for small caps, but probably not enough by themselves. Look, you've still got a lot of companies in some of these indices for small caps that are not profit makers, period, full stop. And so, there's been some buying here in anticipation that lower interest rates would help, but we don't think it turns the tide in favor of small caps yet. That's why we're just neutral here right now. We would be sort of long-term strategic weightings for small caps, nothing more than that. Where we're really overweight is in the large cap area and in those sectors that I mentioned.
All right, Paul, great to get some time with you. That is Paul Christopher. He is head of global investment strategy at the Wells Fargo Investment Institute. And coming up on the close, CenterPoint Energy CEO Jason Wells plugs us into what's driving power demand and how it plans to meet the surging needs for electricity. Plus, we'll get a temperature check on the energy in Washington as a shutdown looms and what lawmakers are doing to try to come to a last-minute agreement with House Majority Whip Tom Emmer. And from Capitol Hill to the C-suite, a wide-ranging conversation on the state of the global markets and the economy with Bob Sternfels, McKinsey Global Managing Partner. All that and more coming up This is The Close on Bloomberg.
Welcome back to The Close. I'm Romaine Bostick.
It's nice to see you.
I know, Katie. You started the show without me.
I know. You know, I had to do both of our little dances. So
Both of our little dances.
I'm
well,
tired
don't worry.
now.
All right, I'll tire. Well, I'll give you a break right now because we're going to get to our top calls, Katie. I know
right.
your favorite portion of the show here, where we look at some of the big movers on the back of analyst recommendations. And we start off today with FCX, Freeport-McMoRan, with Bank of America boosting the stock to buy, maintaining a $42 price target, with the analysts hopeful that the company's timeline for getting that key Indonesian copper mine back online is reasonable. The shares up 4% on the day. Next up, Spotify, Goldman hitting pause, downgrading to neutral and raising the price target, though, to $770, but just from $765. The analyst basically saying the risk reward right now, balance ahead of the third quarter earnings print, with a significant chunk of the growth already priced in. The shares down 5% on the day. And finally, let's take a look at Instacart. BTIG cutting back, taking it down to neutral, removing the price target, which had been at 55. The analysts concerned about growing competition with Amazon, DoorDash, and Uber, all expanding their grocery delivery operations. Instacart down another day, 4.8%, and those are some of our top calls. Meanwhile, let's take a look at a stock moving in the opposite direction. Pfizer up 7%. This after the company locked in a 3-year grace period from the Trump administration's planned tariffs on pharmaceuticals. Now, under this agreement, Pfizer would sell some of its medications at a 50% average discount on a new government website that is actually going to be called Trump RX, which is aimed at providing drugs at discounted rates. Joining us right now is senior analyst over at Bernstein covering U.S. biopharmaceuticals, Courtney Breen. She's got a market perform and a $30 price target on Pfizer. This seems like good business, Courtney. What do you make of it?
Hi, it's great to be with you today, and it's remarkable to be with you as we're seeing pharma stocks all move up positively today, which has not been something we've seen over the last 6 months. There has been meaningful pressure on this industry and on this sector in the form of multiple compression, which was actually called out by Albert Bourla in the press conference today. And that has really come down to the fact that we've had real policy uncertainty. First on tariffs, but most importantly and most dominantly on drug pricing and what the drug pricing environment might be here in the US. What we're seeing today is a positive reaction from investors for that uncertainty disappearing. We now have a framework, we now have a path forward, we now have clear expectations on what this might look like in terms of how companies are going to evolve when it comes to their drug pricing, but also kind of perhaps reassurance that we're not seeing a step down or a material step change in prices in the US overnight.
I am curious, though. I mean, I know there's still a lot of details that we don't know, but as we move forward here, if Pfizer is indeed agreeing to a certain threshold on the price level in terms of what it charges, what is the balance in terms of protecting their margins between whatever they have to give up on price there and maybe whatever they want in terms of the concessions on the tariffs?
Yeah, it's a great question. So I think it's important to know that when we think about the tariffs themselves, we did get an announcement on Friday or Thursday, it might have been even last week, in terms of kind of some of the Section 232 pieces. And this agreement today with Pfizer suggests that's now going to kind of dissipate for them over the next 3 years. However, it's important to know that Pfizer, like many of the other pharma companies, had done a lot of work over the course of this year to mitigate any potential impact of these tariffs, both in terms of inventory pull forward, as well as in terms of kind of those manufacturing and capital commitments here in the US. In terms of the exchange or the deal that was struck today, in my mind, much of this is really attuned to drug pricing, that recognition that the environment and the perception of drug pricing in the US was not going to be sustainable going forward. Something had to be done, but it was important to get on the front foot, transact with the administration for a deal that enables net prices to still be sustained in a meaningful way in the US and ex-US environment and give much more uncertainty for these companies going forward. So this is really a trade of kind of perhaps a give in a few places that perhaps the companies have the ability to give. Medicaid, for example, a strong part of this conversation, is less than 5% of the US business for Pfizer. Same goes for many of the large cap companies. MFN on new drug launches. Also, this gives you the ability to perhaps have a different kind of negotiation ex-US and enable these companies to do better than they have in the past. So this is not necessarily a full give, but rather a nice situation for these companies to have transacted and released the uncertainty in the environment.
Well, Courtney, let's talk about that ex-US component a little bit more. I think you think about the ripple effects here. What could this mean when it comes to the cadence of drug launches in foreign companies or countries rather, and how those drugs are actually priced?
Absolutely. So I think there are a lot of strategies that are deployed even today when companies think about their regulatory processes that they engage in with all the different countries around the world that then translate into their price and access negotiations and the sequence in which they launch those products and agree to different price concessions around the world. We are likely to see those strategies evolve. We are also likely to see potential extension in the time from a launch in the US to a launch in another country that perhaps previously had expected much lower prices. Companies are going to perhaps be a bit more disciplined in not being willing to accept those lower prices because they put the US at risk, and therefore have a stronger backing to perhaps take the time and try and demonstrate the value of their products and get that country to agree to that, rather than perhaps rushing for speed and not necessarily being able to keep that net price high in the ex-US environment. So perhaps we're going to see slower launches around the world, but we're likely not going to see a material change in peak revenues for products. Companies are going to be very good at managing the situation.
All right, Courtney, really appreciate your insight. That is Courtney Breen. She is senior analyst over at Bernstein, covering U.S. pharmaceuticals. It's interesting, Romaine. It's not just Pfizer. You're seeing shares of other companies pop on this, maybe this being a blueprint.
Yeah, and I thought what she said at the start of the interview was really key here. The idea of just the uncertainty. And we talk so much, it's almost cliche to talk about how markets want certainty, but so too does the C-suite, right? You crave it. At least you know what you're going to get, and then you can sort of plan around it and protect your revenue and profits as best you see fit. So hopefully this is a start. We'll see if it sticks.
Absolutely.
Yeah. All right, when we come back, we're going to talk energy. Katie Greifeld, CenterPoint Energy, unveiling a plan to spend a record $65 billion over the next decade. A conversation when we come back with the CEO, Jason Wells, exclusively here on Bloomberg.
Well, utility provider CenterPoint Energy will spend a record $65 billion over the next decade to meet surging electricity demand, the company said in a Monday statement. Now, much of that growth is coming from Texas data centers and crypto mining operations, with some expecting power demand there to double in just the next 5 years. Joining us live on set for an exclusive interview, I'm pleased to say, is CenterPoint Energy CEO Jason Wells. Jason, great to see you.
Great to be here. Thank you.
So we'll talk about crypto mining maybe, but let's talk about data centers, because that is definitely the hot topic of the year. So you think about some of these growth forecasts. What does it mean for CenterPoint Energy specifically when you look at your queue of data centers?
You know, it's just an incredible opportunity for us. You know, it took us about 100 years to build this system, and as you said, we may double it over the next 5 to 10 years, really largely driven by data centers, advanced manufacturing, energy exports and refining, logistics and life sciences. From a data center standpoint, it is all about speed to power. And fortunately, in the Texas market, we have excess capacity today where we can timely connect these data centers and get their chips processing quickly. And so we have seen a dramatic increase over the course of the last year.
So you're joining us on a day where the Bloomberg Big Take is all about AI and how data centers are causing electricity bills when it comes to Data Center Alley in the Virginia region to really skyrocket for residents. And I'm curious what the situation is in Texas, whether there's more that needs to be done to ensure that those costs aren't actually passed on to residents.
You know, I think each electric system in the U.S. is a little bit different. And we're really fortunate in the greater Houston region to have been able to keep bills flat since 2014. Part of that is we continue to see just a mass influx of residential customers each and every year. To try to put this in a little bit of context, we see a city the size of Ann Arbor, Michigan, Stanford, Connecticut, moving into the greater Houston region each and every year. And so as we build that system out, we spread those costs over an wider base. And so right now, we're charging customers today what we charged them in 2014. When we look forward, we're able to keep our rates well in line with the historical rate of long-term inflation.
I'm curious, though, but as you go forward, and the demands now on the system are, I guess, a little bit more layered than maybe, I mean, I guess they've always been layered, but probably more so when you start to factor in data centers and such here. How do you sort of address that on your end to make sure that you can make sure you get reliable enough power to those data centers at a cost that they are comfortable with, and at the same time, you know, for a person like me, that my home can also be powered at a cost that I'm comfortable with?
That's it. I mean, you know, we've in the greater Houston region have been connecting these what we call large loads, these large customers, each and every year. So we have that recipe down. When it comes to making sure that we maintain affordable service, we have to make sure it's both reliable and resilient. Resilient because we're on the coast, we're impacted by storms. Reliable so that it's up and running every day. What we've been able to do is thread that needle of making sure that we have the right level of investment to accommodate that growth, to make sure it's reliable. But since we're spreading that cost each and every year over a wider customer base, that's why we've been able to keep the rates flat over a decade.
With regards to this investment and the build out of the network, is that going to keep pace or catch up with the investments that we've seen in these new, I guess, energy hungry areas?
I'm absolutely confident that in Texas we're able to keep up. This is kind of what we've been doing for decades. It's accelerating at a faster rate. But the recipe in terms of connecting these customers is a tried and true playbook for us. And so we will keep pace. The energy supply will be there. We will lean into this next opportunity.
With the tens of billions of dollars that you have to deploy for this, I mean, where is that money going to come from? You're going to go back to equity markets, to the bond markets? Where is it going to come from?
It's a mixture. About 50% of it comes from the debt markets. We're in the process of selling one of our Ohio gas local distribution companies. We're going to recycle those proceeds back into Texas to help facilitate that growth. So we're thinking constructively about tapping a number of different markets. We're in the market today for a hybrid instrument, whether it's equity, hybrids, debt, selling of assets. It's all of the above to help efficiently fund this growth.
And you think that investor appetite is going to be there?
Absolutely.
Jason, really appreciate it.
Thank you for your time.
Jason Wells there. He is the CEO over at CenterPoint Energy. In just a minute, we're going to go back down to Washington, where we are keeping an eye on that fight over the fiscal budget, a potential government shutdown that could come at midnight tonight. The Republicans have a bill on the table. The Democrats, at least right now, don't seem willing to accept it. We're going to talk with the House Majority Whip, Tom Emmer, when we come back after the break. Stick with us. This is The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. About 30 minutes until the bells ring and a couple of hours until we hit that midnight deadline.
Yeah, I kind of feel instead of showing the skyline of New York City, we should have showed the skyline of Washington, D.C. You're taking a look inside the Capitol building right now as we are waiting a vote, a potential vote here on two particular budget measures that could potentially keep the government open. But at least based on what we know right now, Katie, Democrats and Republicans still far apart on some of the sticking points that would allow the majority of those Democrats to actually vote for this bill in the Senate.
Absolutely. It seems like the odds are pointing to a shutdown. So let's get down to Washington right now, where House Majority Whip Tom Emmer joins us live from the Capitol Hill Rotunda. Representative, great to have you with us. So as we mentioned, midnight is fast approaching here. Is there any chance that the U.S. government stays open past midnight tonight?
Oh, absolutely. I mean, thanks for having me, Katie. Romaine, good to be with you guys. First off, the House Republicans actually did the reasonable and responsible thing by passing a completely clean continuing resolution. It's about a 7-week resolution to November 21st, the purpose of which is to allow the Republicans and Democrats who are involved in a conference committee as we speak to finish their work on appropriations bills so we can start to move back towards a regular appropriations process. They believe they're close. This gives them a little time to finish those negotiations and see if they can wrap those up. In the meantime, what we sent is exactly what Democrats in the Senate supported just 6 months ago, Katie. And more importantly, it's the exact same thing that they voted on 13 times under the Biden administration. I'm hopeful that they're going to come to their senses. When I say they, it's really Chuck Schumer in the Senate, and that he will keep the government open, because a shutdown does no one any good. And if he does choose to shut it down, it'll be the Chuck Schumer shutdown.
Well, let's talk a little bit more about the Senate Democratic leader. He was just speaking to reporters a couple minutes ago. He says that the GOP has until midnight to, quote, get serious on health care. You think about some of the issues raised there. The Democrats, of course, have sought an extension of the health care subsidies and a reversal of the Medicaid funding cuts that were part of the president's tax legislation from earlier this year. What are the odds that the Republicans could budge, maybe give a little bit when it comes there, or at least have some sort of promise that those discussions will continue, even if we get something passed tonight?
I think they've already been told that the discussions are going to continue, but you got to keep the government open. And what Chuck Schumer says and what actually is the case, what he's asking for, are two completely different things. What he's asking for is another $1.5 trillion in spending. What he wants to use it for is to put 1.4 million illegal aliens back on taxpayer-funded health care. What he's asking for is $500 million for radical news outlets, support radical news outlets. What he's asking for is to cut $50 billion from rural health care. So when he's talking about we got to get serious about health care, I'm not sure where he's coming from. It sounds like he wants to give illegal aliens taxpayer-funded health care and cut rural Americans' health care. So really, the clean CR is the right thing to do. He knows it. Everyone in this town knows it. If he shuts the government down tonight, it is the Schumer shutdown, and he's the one who's going to bear responsibility.
Well, I mean, I understand that. But when we talk about, Representative, what a shutdown means, or at least the optics, I should say, for regular folks, I'm not talking about people like you and me who understand how Washington works. I mean, when you have to go back to your district in Minnesota, assuming that there is a shutdown, I mean, what is the message that you have for those folks who are not only maybe potentially out of a job, or at least have family members who are affected by this?
Yeah, call Chuck Schumer. My message is call Chuck Schumer. Tell him that this is not going to work for the 20 to 35,000 Minnesotans who are either federal employees or federal contractors. It's not going to work for families who rely on different federal programs. This is not the right thing to do, and Chuck Schumer knows that. He's acting purely based on political instincts rather than what's right for the American people. So I say, yes, I'm concerned. Call Chuck Schumer. Tell him, Chuck, don't shut the government down. Let's keep it open. Let's make sure that Republicans and Democrats can continue their work and get this government funded for the long term.
If we miss the deadline, there's been a lot of discussion, including from the president himself, about doing more than just temporary furloughs. I am curious as to what discussions you've had either with the president or with the OMB director, Russ Vought, about some of those threats to actually effectively permanently remove some workers should we actually reach a shutdown.
Well, I wouldn't disclose my conversations with either of those two, whether it's Russ Vought or, more importantly, the President of the United States. That's between us. But I would tell you this. If you want to avoid any of those furloughs or even beyond that has been discussed, do the right thing. Chuck Schumer should pass the Republican clean CR. It's not partisan. Again, it's something that Democrats have done 13 times before under Biden. Romaine, what's changed? Nothing's changed except the guy that's in the White House. So don't do it based on your like or dislike for the President of the United States. Do it because it's the right thing to do for the American people. And if you don't, they're the ones that are going to answer for it. Chuck Schumer and Democrats are going to answer for a shutdown.
Let's talk about the labor market more broadly here, because there's been a lot of discussion that should the government shut down, that when it comes to the Friday jobs report scheduled at 8:30 a.m., that the Bureau of Labor Statistics won't be able to actually release that data. You think about where the Federal Reserve is. They need that data to make policy. We know that this president would like to see interest rates lower. It's harder to make monetary policy when you don't actually have the economic data that you need. So, Representative, in your view, should the BLS get a carve out here so that they're able to remain operating?
I got to tell you, I love that you say the Federal Reserve needs to have data in order to make decisions. Jerome Powell has been months behind. He was too late dealing with interest rates under Joe Biden. I would presume it was political reasons that he delayed. And because of that, we ended up with 40-year high inflation. We hadn't seen it in 4 decades. Now, he should have lowered interest rates quarters ago, and he continues to delay. So trying to suggest that, statistics are going to make a difference in this case, there are more than enough jobs out there. If people are willing to work, they're going to find work.
Well, I mean, they still need the data, though. And I mean, you know that, Representative. I mean, even as we're speaking right now, there are at least 2 Fed members addressing this issue publicly, including Austin Goolsbee, the Chicago Fed president, specifically talking about the potential of not having, basically, data going dark, if you will. And for a Fed that I think we all realized was kind of on this inflection point as to whether they continue cutting rates, I mean, the stakes for this are a little bit higher than maybe past shutdowns.
Well, that's good, Romaine. You can focus on government data. There's plenty of private economic data out there that can be relied on. And frankly, maybe they should have been relying on that private economic data for months now and bringing interest rates down instead of delaying, as Jerome Powell has done. So, look, if there is a government shutdown, if you're that worried about the government data, then tell Chuck Schumer, keep the government open. That he has to do the right and responsible thing, just like House Republicans did. Make sure the government continues to operate if that's your concern.
Representative, do you have any sense here that you will actually see a number of Democrats actually break ranks and support this bill in the Senate?
If they don't, it's going to be on them. So I do. I think you got some senators from Maryland, some senators from New Jersey, Georgia, New York. You've got a lot of different senators, Democrat senators out there who their constituents will be impacted, and they're going to have to go home and explain to them, well, I had a chance to keep the government open, and I wasn't giving anything to Republicans. I was keeping it exactly the way it is, but I chose not to because Chuck Schumer was afraid of losing his job.
Yeah.
I think do the right thing, be responsible. I think we've got people in the Senate that will have a very difficult choice.
And just a quick final question here. Are you planning to stick around through the weekend? I mean, we have a holiday, a Jewish holiday coming up on Thursday, which I know could potentially disrupt congressional proceedings. What happens next?
Well, as far as the House is concerned, we've done our work.
Okay.
I mean, we sent a nonpartisan, clean CR. Our leadership is all here. Several members are in town. But as far as what we're going to do, it's up to Chuck Schumer and the Democrats in the Senate to make sure they keep the government open at 12:01 tomorrow morning. So we're waiting to see that. Hopefully that's what's going to happen, and then we can get on with the appropriations process. If Senator Schumer is dumb enough to close the government, it's going to be on the Democrats. It's going to be the Schumer shutdown.
All right, we have to leave it there. Really appreciate you taking time for us. House Majority Whip Tom Emmer there, who's been representing the 6th Congressional District in Minnesota for the past decade. When we come back, we turn back to the markets and we turn back to CoreWeave. It's our stock of the hour. This is The Close on Bloomberg.
I think we are facing almost a gold rush type of mentality about the pace and scale of technological change that we're seeing around us. Things are moving really fast. And I do think that there's wonderful promise associated with this. But it's going to be hard to get there.
That was part of my conversation with Bob Sternfels, who leads McKinsey as their global managing partner. The future of AI, a conversation that has been timely day in and day out, including today, an announcement regarding CoreWeave signing a deal to supply Meta Platforms with $14.2 billion worth of computing power. It is our stock of the hour, and Norah Mulinda joins us to talk about, well, what exactly is happening. I saw the CEO commenting about, said, hey, they liked us before and they like us even more now.
Absolutely.
Yeah.
I mean, they've received some criticism over the fact that their concentration has really been reliant specifically on Microsoft here. I mean, Microsoft accounts for more than 70% of their sales. So the fact that they're able to ink this deal here with Meta Platforms, it really just shows diversification. This is what investors want to see. They've been on a tear since they IPO'd back early in March, up more than 242% since then.
Yeah.
So it really is a strong year for them, and they've been seeing a strong showing since they debuted. But I think people are really looking for diversification here, and that's what you're seeing right now here in this deal.
Diversification, it matters in portfolios, in revenue streams as well. Let's talk a little bit about what Meta gets out of this exactly.
So they're actually going to be getting as much as $14.2 billion and access to computing power in particular here. So this will actually run through 2031, and they do have the opportunity to also extend this into the end of the year following there. So it really is a great relationship here for Meta Platforms, and as we kind of think about this partnership here between the two companies as it relates to boosting artificial intelligence.
Yeah, it'll be interesting to see, though. I mean, not to be flippant about this, but is this real diversification? I mean, to go from Microsoft being your largest customer to now Meta being your second largest. I mean, great customers to have.
I mean, great customers, big names, but I mean, I guess the next step here is where do they go next? Who else are they reaching out to? So I imagine that there's going to be more conversations to come beyond this, but we'll just have to see.
It's all about the direction of travel versus the absolute level, at least.
That's deep.
Thank you. Right. God, many more nuggets of wisdom. But Norah, Mulinda, great reporting as always. Coming up, with the S&P 500 still on track to close the month out higher, we'll take you to the closing bell up next. This is The Close on Bloomberg.
10 minutes until we get to the closing bell, closing out this Tuesday afternoon, closing out the month of September, and I'm told, Katie Greifeld, closing out the third quarter of 2025.
And the quarter. We are almost through with 2025. Let's take a look at how we stack up right now on the S&P 500. Limping to the finish, we're looking at a 0.3% gain. All told, if this holds, we'll see the S&P 500 rise by about 3.5%. This was supposed to be a bad month. Didn't exactly happen. The NASDAQ 100 higher a little bit as well. The bond market not doing anything.
Yeah, I remember a lot of stories, kind of like in late August, early September, talking about how this was going to be. I feel like one of your bylines was on those as well. But we get to it was kind of interesting. I mean, we came in all seriousness with this idea that not just the seasonality was going to work against stocks, but of course all the other issues going on geopolitically in Washington. And we've seen this kind of, I hate to use this phrase, but climbing that wall of worry, as we've seen pretty much going back all the way to those lows in April.
There's plenty of stories of 2025. I think one of the stories is that seasonality hasn't really been your friend. You think about April sort of defying expectations, sell in May and go away. That didn't work. September, not so scary. So we'll have to see how the next 3 months happens.
Well, the S&P, Dow, and Russell right now locking in what is going to be a fifth straight month of gains. Jeff Blazek joins us right now, multi-asset CIO over at Neuberger, Berman. And I am curious as to whether, Jeff, you are surprised by this run that we've seen in stocks going back to April.
Pleasure to be here. Yeah. We're not. We are very bullish now and have been ever since April when we upgraded global equities. And we think the momentum will continue into 2026. Please.
I'm curious what you think continues to drive that momentum. What is the upside catalyst?
Well, the fundamentals of economic growth above trend in the U.S. prior to this year. We did have a deceleration in the first half, understandable with all the noise around trade. But the consumer is resilient. There's tremendous liquidity and wealth that can backstop some of that short-term volatility. Now what we have is the stage is set. So back in April, we called it the storm before the calm. If we could get through the trade disruptions, get clarity of how that was going to transmit through the economy, we have a lot of stimulus on the table. We have mergers and acquisitions picking up. And we think that we can see low teens earnings growth globally that will really continue to augment equity returns for the time being. And we also very much like the way that translates in private equity.
Well, let's talk a little bit about the storm before the calm, because I've heard it trotted out a few times that now that we have clarity, you're seeing some of that activity pick up, especially when you talk about M&A and the like. But do we have clarity, or just has this market gotten used to all of the uncertainty, all of the noise that comes with these trade negotiations?
There probably is some adaptability to it, and we all remember where we were on Liberation Day. Now we realize that sometimes the bark is worse than the bite. These are negotiating ploys. But we study on a monthly basis how much is being collected in tariffs, and it's nowhere near as punitive as what was envisioned originally. We will have to study over time to see whether it's the producers, the importers, the consumer that is going to bear that cost. And there is about $30 billion a month that's coming in. But even with the government shutdown, look at the way that the equity market is behaving. Up on a strong month, strong quarter. the market is willing to look through this noise in the headlines because, again, it comes back to the hard data. It shows strong economic growth, strong spending, and strong corporate earnings.
Interesting that you bring up the hard data because we got some interesting soft data this morning in the form of the Conference Board Consumer Confidence Measure actually falling in September. But I feel like this has been the story for a while, certainly since the pandemic, that some of the sentiment measures look not so great. We've recovered some, but still. But then it doesn't really translate necessarily into the hard data. How do you approach that from the perspective of being an investor?
Yeah, we look at what people say, sentiment, and what they do in terms of their spending. And maybe they are fearful about other elements or uncertainties, but when we look at day-to-day spending on goods, on industrial spending across the board, it really is a good backstop. The one area I would say on hard data that unfortunately we may not get to see on Friday morning, and I always eagerly await that at 8:30 on Bloomberg. But with the government shutdown, we're not going to get a pretty important data point on labor. And that is the one thing, there has been a dramatic deceleration in job growth. So 6 months ago, we thought the job economy was growing about 150,000 a month. We're down somewhere in the 20 or 30,000. Yeah. So we really would like to see that settle in, but often employment can be quite volatile.
Are you preparing for a shutdown, or I should say more importantly, a prolonged shutdown with regards to maybe not having the data and not having the visibility that you would normally have as an investor?
Yeah, we're watching it closely. Yeah. We're not altering portfolios based on it, and the duration is going to be key. We've studied the last 20 or so shutdowns that have happened over the last several decades, and when you look at it, sometimes, like in 2018, it was a pretty violent reaction before, and once it was settled, there was off to the races. But on average, it tends to be noise, and so that's the way we would look at it in this period. But obviously, if we go several weeks, we have to reassess that view.
There was some concern, and we had Tom Emmer on, the House Majority Whip, who kind of talked about this idea of relying more on private data if we don't get the government data. But it raises the point here about, A, how reliable you think the data we are getting. Is it, or I should say, is it giving us a real accurate picture of the state of the economy? But it also feels different because we are kind of at this inflection point where these future stock market gains do seem to be dependent on the Fed continuing to ease. But if the Fed is telling you, well, we're not going to do anything unless we actually have that data to be able to back it up, where does that leave us?
Yeah, we've been writing about the Goldilocks blend, and we're still testing the porridge. And unfortunately, when the data comes out, we don't know. I mean, that one felt hot, but it ended up being cold when we looked at it 2 months later. It's weird to revise the porridge, but that's where we are. And with the ADP tomorrow will be really important. It's going to probably be one of the more important ADP reports we've had, because we know in all likelihood Friday is not going to happen. Yeah. Look, it is really important to not see, I think when good news is good news or good news is bad news, that's where we are in this Goldilocks scenario. But if we can get it, and our general view is we will get 2 more cuts this year, maybe 1 more cut next year, it really sets the stage for a more robust rate for the Fed funds, and that will extend to smaller businesses.
And before we let you go, just quickly here, you talk about rate cuts and what it means for the stock market. What would it mean specifically for the small caps? That's been one of the evergreen conversations. They just can't seem to get their sea legs.
I know. It's been an area that we have been early. We've been overweight small caps for at least a year, according to our asset allocation committee. We are now getting more enthusiastic because we do see the catalyst of lower rates. Also, ironically, even though small businesses tend to be more domestic, and you would have thought better insulated from the tariffs, it turns out they had very narrow margins, and their costs were hit more by that. So, and small business sentiment also weighed on it. Now that's reversing, rates are coming down, cyclical recoveries in motion, so we think small cap is going to start to work, and they're very cheap.
All right, great stuff. Jeff Blazek there, multi-asset CIO over at Neuberger Berman. As we count you down to the closing bells, we do want to bring you some breaking news. This involving Occidental Petroleum and Berkshire Hathaway. We are learning, according to a Wall Street Journal report, that Berkshire Hathaway is near a deal to buy Oxy's petrochemical unit. This is a unit that makes up about 20% or 18%, I should say, of their total revenue.
Yeah, this is interesting. We had been on the look for maybe a rail deal from Berkshire.
Yes.
Didn't get this. We were looking in the wrong place. I will note that the last major deal Berkshire did was all the way back in 2022.
Yeah, a lot of people keeping eyes on those 13 Fs. It's seen the buildup in Oxy. Well, now we're getting a response. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. There's Carol Massar. There's Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including YouTube, here on the final trading day of the month and the quarter.
I know.
Right now, looking at an S&P 500 and a Dow and the Russell 2000 locking in a fifth straight month of gains.
Yeah, pretty significant, right? We saw some buying into the close here. We saw that in like the last half an hour or so of trading. I'm just looking at the S&P 500, folks. In the third quarter, it's up about 8%. So not too shabby if you're a bull in this market.
If the government shuts down tonight, do we still have to come in tomorrow?
When did you become Debbie Downer?
I'm just wondering. Is that, do we come in?
The show must go on, Tim.
Okay. You know, we asked Jan van Eck whether we should care, whether investors should care about the government shutting down. In a word, he said no. We care about fiscal policy, monetary policy. We care about technology. And he said, government shutdown is not going to change fiscal policy.
No, it may not, but I think there are some implications to this shutdown that differ than what we saw in 2018, certainly what we saw back in 2013, and even beyond that. You're talking about shutdowns that were maybe a little bit more genteel in nature. I think some of the rhetoric, and if they make good on some of that rhetoric, we could actually see much more of an impact than in the past.
And you think about the urgent question. Romaine brought up the point that, I mean, if we don't get that government data on Friday when it comes to the Federal Reserve and their rate cutting cycle, there's a lot of questions there.
Yeah, and we talk about the idea that a market is pretty much perched at those record highs, a market that, of course, wants to move higher, but they really do need, or at least they think they need some help from the Fed to do that. If the Fed doesn't have the data, then maybe you don't get the move. Nevertheless, we lock in the gains on the day, on the month, and on the quarter. An S&P 500 higher by just 0.4%, but that's up 27 points on the day. Good enough for a 3.5% gain on the month and an 8% run over the past three. The Dow Jones Industrial Average posting similar gains here on the day, up about 0.2%, and also closing out higher by about 2% on the month. The NASDAQ Composite and the NASDAQ 100 each up on the day and about 5.5% on the month. And the Russell 2000, your relative laggard, it is adding on the day, but for the month, only up by about 3% relative to the rest of the space.
All right, S&P 500 on this final trading day of September and final trading day of the third quarter. You've got 301 names, Katie, to the upside, 201 to the downside. If I look, Katie, at the third quarter, AppLovin, your best performer, and then you've got, I think, FactSet at the bottom of the pack.
Oh, yeah.
All right, there you have it. Let's take a look at the circle of sectors right now. You can see there's a lot of green here. Big tech really doing a lot of heavy lifting. So, too, did healthcare on the day. We know that Pfizer agreeing to lower drug prices in exchange for some relief on tariffs. That is boosting the entire sector. In terms of what isn't doing so well right now, energy, consumer discretionary, communication services, some of your downward weights on the index. But overall, green on the screen.
All right, so let's get to some of the individual gainers, if I may. And let's go to CoreWeave, guys, because this one up 16.5% at its highs today, finishing the day with a gain of just shy of 12%. You know, one of the neoclouds, businesses that rent out access to leading AI chips, while the stock rallying after the company signed a deal to supply Meta platforms with as much as $14.2 billion worth of computing power. It runs through December 2031 with an option to extend through 2032. So talk about some visibility with additional capacity. And what's really key about this, and we talked to our Ed Ludlow about this, is why you saw really the stock rally, is that it kind of diversifies business away at CoreWeave, away from Microsoft, so expands who its top customers are. So this is why potentially you saw this one rally, particularly in today's session. Again, keep in mind, it IPO this year. It's up about 273% year to date. About 10% of the float is short, but definitely one of the outperformers here so far in 2025. All right, Pfizer, got to talk about the pharmaceuticals. Higher today, many of the names top in the S&P 500. In fact, Pfizer is your number one gainer in the S&P with that 7% gain. We did have President Trump speaking earlier at the White House, saying Pfizer's agreed to offer countless prescription medications at major discounts in the U.S. as a result of the most favored nation drug pricing order. We did also see the Pfizer CEO at the White House. Pfizer will get a 3-year grace period from President Trump's pharma tariff. So a lot going going on and implications for the pharmaceutical sector, including Pfizer. And then, just because I like French fries, I'm going to do Lamb Weston. This stock up almost 9% at its highs today, finishing with a gain of more than 4% here. This after the company reported adjusted earnings per share and net sales for the first quarter that beat consensus estimates due to improved restaurant foot traffic. Apparently, chicken fast food restaurants in particular saw more visitors. Excuse me.
They're everywhere now. You know,
What, French fries?
Yeah, no, like these Raising Cane's and all these chicken places. Like they were never anywhere, and now they're everywhere.
I know.
I can't get rid of them.
With French fries.
Did you see Wendy's has new tendies?
Oh.
Tendies?
Pick up there, Tim.
Okay, I thought you guys were. I didn't want to jump in.
I don't want to go down that rabbit hole.
Let's go. Let's do decliners here. I want to talk about Spotify shares falling 4.2%. This after the company said that CEO Daniel Ek is transitioning his role to chairman, leaving his leadership in the hands of co-CEOs Gustav Soderstrom and Alex Nordstrom. Ek will continue to provide support and guidance, and Soderstrom and Nordstrom will jointly take the reins of the company effective January 1st. I mean, it makes sense, but I was surprised. 20 years ago, pretty much, 2006 is when he started Spotify. So he's only 42 years old, but he's been at the helm of this for 19 years. He'll still be very involved in the company. He said, "I'll remain deeply involved in the big defining decisions about our future." Still, shareholders sending shares lower today, 4.2%. Also, shares of companies that do sports betting, such as DraftKings, falling today. DraftKings down 11.6% after Robinhood posted September-to-date trading metrics late yesterday that showed contracts traded were about 187 million. Robinhood has emerged as a competitor to sports betting platforms like DraftKings and FanDuel, as bettors are allowed to trade contracts on the outcomes of sporting events through Robinhood, so increased competition for those pure play sports betting apps. And finally, some late breaking movers, Zillow and Rocket Companies. I want to focus on Rocket Companies. It's the parent company of Redfin. Rocket Companies falling today close to 4%, 3.8% down. The FTC sued to block a partnership between Zillow and Rocket Companies, saying that it would reduce the number of websites offering apartment listings and drive up advertising prices. This partnership was announced back in February. It involved an upfront payment of $100 million from Zillow to Redfin to help Zillow enter into advertising agreements with property managers that post listings on Redfin's sites. The FTC said the arrangement combines two of the three largest internet listing service, and it's seeking a divestiture of Zillow's assets. Zillow fell, by the way, by 4.3% as well.
Yeah, absolutely. And I just want to point out, too, honorable mention, keep an eye on some of those consumer finance stocks, a big drop in Capital One and some of the other credit card companies. Meanwhile, in the yield space, a relatively quiet end to the month. But we should point out that overall, you did see actually a drop in yields over the course of the month. And actually on a price basis here, you actually had some pretty decent returns when it comes to not only the Treasury market, but of course, the corporate fixed income space as well.
All right, so remember we were all at home and we all were working from home and we were creating spaces in our home for home offices, and we thought, you know, we're not going to have to go to the office as much, and even after the pandemic was over. Well, it turns out, as we all know, yes, employers want us back in the office. And what's interesting is, Tim, what's turning out as we report, our Sarah Rappaport, everybody is now turning their home offices into other spaces.
Okay, so those other spaces include things like Pilates studios, a golf simulator room,
Nice.
cigar lounges,
Okay.
Keep going.
and places for your kids to go. I think that's what mostly people are doing. I don't
He
see
doesn't
many.
need any more room.
I got to tell you, never been to a cigar lounge inside someone's house.
Yeah, it
But maybe I'm
sounds-
just not hanging out in the right places with the right people.
Sounds a little stinky. I will say there are some great photos in this article. One of them is of a room that's focused on flower arranging. It just sounds like these people are swimming in space.
How many flowers are they arranging?
I don't know.
How do you do
I
that?
don't
Well, you're going to
actually-
if you go to the office every day, how are you able to arrange flowers?
When you go home on the weekend.
Okay.
Where's all this free time?
Your ample free time and your ample space in your house. Let's talk about another story that caught our eye. Of course, we're awaiting Nike results. There was a great story on the terminal today.
What would you put in your room?
In my room?
Yeah, if you had a free room and you could just make it.
Well, horses are really big. I'd probably just have a room for my cat, but
You said that a cigar lounge sounds stinky, but having a horse inside your home, I think
definitely stinky.
No, I crave the smell of
And they
horses.
kick the wall,
Anyway,
too.
let's talk a little bit about New York City's running boom. As I mentioned, we're awaiting Nike results. There was a great story about
horses
how
and running. This is like the Katie Greifeld special today.
I know, or it was going to be. But the running boom, apparently it has generated an estimated $934 million for New York City's economy in the fiscal year through March. A lot of that is driven by out-of-town visitors, of course, coming in for the marathon and the like.
Yeah, I just want to bring you some breaking news. The redhead crossing the Bloomberg terminal, the president of the United States, Donald Trump, saying that the U.S. has reached a deal with Harvard. We should just point out, I have no extra details on exactly what this is, but he is speaking right now in the Oval Office. You can see him there. We're going to try to get you some more details on that. But of course, the president picking a lot of fights with some of the higher institutions in this nation. And some of those institutions have sought to settle with the U.S. government. Trump now saying that a deal apparently has been reached with Harvard University.
All right, we'll look for some more information in terms of the specifics on that deal. All right, guys, that is a wrap as we wait for Nike earnings expected to cross in about 7 minutes' time. A wrap, our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romain continuing, of course, there on the close on Bloomberg Television, and Tim and I continuing on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And stick with us. When we come back, we're going to talk a little bit more about the state of global markets and the economy. Let's sit down with Bob Sternfels, an exclusive interview with the global managing partner of McKinsey. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic here on a day where we did see stocks close out the month slightly higher. We should point out that for all the discussion here about how September would actually be seasonally bad for stocks, that did not necessarily play out. All of the major indices here in the U.S., the Dow, the S&P, the Russell, and the NASDAQ, all moving higher on the month into the green. One big index that did get left out was the Dow Transportation Average, down on the day and down on the month. You also saw weakness in the dollar on the day and on the month. But what a phenomenal run it has been for gold. Higher on the day, Katie. That is a record high, 38.52. In fact, this was actually the best month for spot gold going back to August of 2011. And I don't know if you remember what happened back then. That was, of course, the month the U.S. debt rating got downgraded from AAA because of concerns about the budget.
There you go. I was graduating high school, so I was a little light on that history, but what a fantastic
You can't see
run
me waving at you right now.
It has been for gold. Let's talk about some of the individual movers today. I had to highlight Pfizer, of course, cutting that deal with the Trump administration. It's going to lower its prices, get a reprieve when it comes to tariffs. Interestingly, you saw Merck rise by just as much. Maybe that deal, of course, will be a blueprint for the likes of Merck and some of their peers. A different story when it comes to MGM. We talked a little bit about Robinhood's inroads into prediction markets. Now you have analysts saying that could dent the likes of MGM. Shares down about 5%. But let's talk about our top story. We get Nike results that are just moments away, and investors really looking for updates on the retailer's push to clear out inventory, as well as CEO Elliott Hill's turnaround plan. Bloomberg Intelligence noting commentary on the new Nike Skims brand launch and an update on tariffs. Those are going to be key for this earnings release, Romain. I will point out Nike shares down about 6% year to date, something closer to 20% when you take a look over the past year.
Absolutely. Expectations are a bit mixed heading into that report as we await it. Let's bring in Zachary Warren. He's equity analyst over at CFRA, who helps to cover Nike. And I do want to start off, Zach, first on the inventory, because that seemed to be a big issue the last quarter when we got the report here. I know the estimate, at least based on Bloomberg estimates, is for inventory coming in at just below about $8 billion.
Yeah, Elliott Hill in his, the last Q4 earnings call, he kind of said that this was kind of a new beginning. They're going to start over here and it should be up from here. So that included, inventory they thought would be down. So, it's going to be an interesting report. I think, expectations are extremely low. Analyst estimates are only 27 cents. But the issue is the stock now trades at about 40 times forward earnings. So it'll be an interesting call.
Yeah, super interesting when you compare that valuation to some of the fundamentals here. It seems a little bit out of whack. Talk to us about the international expectations outside of tariffs, of course, which have a big overhang on this company. But when it comes to the China business, what are we expecting to see there?
Yeah, I think that Nike's going to really push internationally because, they get 44% of their sales from North America, which is less than most of its peers. They're much better insulated to the tariffs than others. And I think they probably have a little bit more pull with suppliers because of their size. So I think they're going to push international sales to kind of avoid and offset those tariffs. And I would expect that Greater China is, the first place that they would look.
All right, hold that thought. In conversation right now with Zach Warren, equity analyst over at CFRA. As Nike earnings cross the wire, this is their fiscal first quarter, and the company says that EPS coming in at about 49 cents per share, revenue coming in at about $11.72 billion. On the revenue side, that does appear to be a beat. The street on average was looking for revenue of about $11 billion even. On the EPS side, that also appears to be a beat on the adjusted basis. The street was looking for about 28 cents a share. The inventory number coming in above estimates at about $8.11 billion. The street was looking for $7.92 billion.
Sure.
And gross margin coming in just a touch above the average of analyst estimates. Katie Greifeld, 42.2%.
Yeah, I'm glad you highlighted inventory there. That's actually lower year over year, that $8.11 billion. But again, as Romain mentioned, above estimates. You take a look at what shares are doing right now, trending higher. Of course, it's still early, and you can see that we've been wiggling around a lot. But at least for right now, higher by about 3% post-market, Romain.
Absolutely. A revenue number, Zach, up about 1% on an overall basis here. Direct revenue, though, down about 4%. Nike brand revenue up about 2%. North America looks strong. Europe looks strong. Still weakness in China, with those numbers in the greater China region down 9.2% on a year-over-year basis. What do you want to hear out of Elliott Hill and Company on the conference call?
Yeah, I think, from the first look at the results, I think this is a really good quarter. I expected a big beat. It was pretty much priced into shares. You want to hear that the return, the return to growth is back, and then that's the new story. You kind of want him to build on that last conference call. You want to hear him, talk about the partnership, like you guys said, with Skims. And then, I really like their focus on sport. I think over the long run, that's what they need to focus on. We'll wait and hear. A little bit of tariff talk, I think, is important as well. So we're ready for the call.
Well, let's talk a little bit about the Skims partnership. Nike Skims, I believe the launch was sometime over the past week or so, just judging by the Kardashians that I follow on social media. But how do you sort of put that into context as an analyst looking at this company and trying to measure the impact on the bottom line?
Yeah, the Skims this early, it's really hard as an analyst. It's really hard to tell just with the first few weeks of a launch. Usually you get pretty good commentary within you'll probably get some tonight, but within the first quarter or two, that kind of tells you, how they're impacting their top and bottom line. I expect this to be very successful. Obviously, Skims has been very successful over the past few years. And I really like, this for Nike. So it will be interesting to see, what's the profit share there between the two companies. If you could get any commentary on that, you probably won't. But it's going to be a fun call. I think, the tariff talk is pretty much top of mind for all investors going into these calls for apparel and footwear companies, because it's pretty much unavoidable, that he tariffed almost all of Asia. So, we think Nike's well positioned, though, because of their size and their international sales.
I'm also curious about their pricing power, Zach. I mean, there was some discussion about under the previous leadership that maybe they got a little bit too willy-nilly with discounting, and it does appear that Elliott Hill is going to try to sort of maybe pull that back a little bit. I mean, when you look at the power of the Nike brand, I mean, how much wiggle room do you think they have in at least holding prices where they are, but if they need to, actually nudging them higher?
I think they'll have no issues holding prices. Nike's still a beloved brand. It's still the largest apparel and footwear brand in the world. And I do think that they are fine. I think the issue for the company is growth. Where are they going to get growth from now? You had COVID where you had a lot of pull forward demand. North America sales outside of COVID have been flat for years. And then, greater China weakness, like you said at the beginning of the call. That's not great for the company, who says they're a growth company, as soon as you go to their investors page. We really think it's going to be tough for Nike. They're just so big. They're obviously a global brand, and you've got new players across all of their spaces. It's just really tough when you get this size.
Absolutely. Well, at least for the moment, Nike shares up about 4% after hours. Zach, great to get your analysis here. That is Zachary Warren. He is an equity analyst over at CFRA. And coming up, we're sticking with those Nike results. Matt Priest, he's the CEO of the Footwear Distribution of and Retailers of America. He joins us next. This is The Close on Bloomberg. We're keeping a close eye on shares of Nike right now in the after hours, climbing after reporting that its first quarter revenue beat estimates here. Investors, though, closely watching any commentary around tariffs. Let's discuss with Matt Priest. He is CEO of the Footwear Distribution and Retailers of America, formerly senior advisor to the Commerce Secretary under the Bush administration. I'm pleased to say that Matt joins us now. So digging into these Nike numbers, I'm taking a look at the press release, and the company notes that gross margin decreased 320 basis points in the quarter. That was partially due to higher tariffs in North America. And this isn't just, of course, a Nike issue. I have to imagine, Matt, that this is industry-wide here.
Yeah, Katie, it's a great question. It's definitely industry-wide. And it's not just industry-wide. It's kind of across all consumer goods. And so we typically pay in a given year about $3 billion in duties on a product that has 99% import penetration. That number is going to push about $5 billion this year. And so when you have that added cost on your imports, it's a tax, that's going to press margins, squeeze margins, and drive prices further.
And so what does the daisy chain look like from, okay, companies are hit with these tariffs, they absorb it to some extent, they pass it on to some extent. How does that reach consumers?
Yeah, so there's a direct correlation between the price of goods at the border, particularly for footwear. As you see that price go up, you see the consumer price index for footwear go up at the same time. Now, there can be a delay, and this has been an unprecedented year, as we all know, and so our companies have fended off price increases as long as they can. But I can tell you, based on our own internal reporting, for the last 5 weeks in a row, our internal sales numbers have not only increased, but the rate of the increase has accelerated. So this past week, we're up almost 14% over the same week last year, which is the fastest growth we've seen in 44 months. And I can say we all remember what was happening in 2022 as it relates to prices.
I am curious about whether there has been meaningful efforts either on your part or on some of your peers to maybe try to negotiate some reprieve. I mean, earlier today, we were all talking about this event at the White House with regards to Pfizer basically striking a deal to lower drug costs in exchange for a reprieve on tariffs. I'm curious if the footwear industry and sportswear overall really has any levers to pull where maybe they can negotiate something for themselves.
That's a really good question, Romaine. I think when you have maybe a 10% increase in the duty rate, there's some flexibility to negotiate. But if you look at a pair of shoes, a pair of sneakers out of Vietnam, the #1 provider of sneakers to the U.S. market, our tariff rate was 20% prior to the reciprocal tariffs. Now it's 40% on a pair of sneakers. And so once you get to those numbers, you can only negotiate price savings down so much and for so long. And so now that those reciprocal tariffs have hit and are in place, it's inevitable. Our members are eventually going to pass on the price increases to our consumers. And that's starting. We're seeing that in earnest. And our consumers, 75% of which in a recent survey that we conducted said we're seeing those price increases in footwear in particular.
I mean, we've just come out of the back to school season for those folks who have children. So a lot of shoes were bought, I'm sure.
Oh, yeah.
We're now heading into the holiday season where, presumably, we start to see an uptick in sales for some of the folks that you represent. How have they prepared in terms of inventory and pricing for the holiday shopping season?
I think our members are well prepared to meet the demand of the consumer. If the demand is increased and up, that's fantastic. But a lot of what we're hearing and seeing, not just within the footwear space, but across broader retail, is an expectation that holiday will be soft. We've seen that from the National Retail Federation reporting. We've seen that on hiring for temporary workers heading into the holiday season. And we've seen from our members, or I should say our consumers, that 48% of them say they need promotional opportunities to purchase shoes this holiday season. And what that tells us is that as we're heading into an environment where the consumer is demanding promotional opportunities and our prices are going up every single week, those two things don't coexist very well together. And so we'll have to see how much price flexibility or elasticity our members have in response to what consumers are saying they need to make a purchase.
Matt? Great insights. Matt Priest is the CEO of the Footwear Distribution and Retailers of America. Nike shares pairing some of their gains in the after-hours trade as we await that conference call with executives at the top of the hour. Meanwhile, we do have our eyes on a lot of moving stories coming out of Washington. The President of the United States speaking in the Oval Office right now about the government shutdown. Let's take a listen.
Based on what we're seeing. But we got it by having people allow that to happen. As you know, I started the process, but then when COVID came, we focused on COVID, not on this. And I said, if I ever go back and do it again, I'm going to make this a primary thing, because other countries are paying a fraction of what we pay for the same exact drug, same exact pharmaceutical, everything. And I said, no, it's not right. And the drug companies actually came along. You know, don't forget, they make 30, 40, 50 million a year, these people. They're very smart. And they had a lot of people convinced that, you know, that's the way it has to be. They talked about research and development. We had to pay. I said, well, why isn't Germany paying? Why aren't other countries paying? And they always had a good answer, but it got to a point where I didn't like the answer anymore. And I said, we have to do this. And we did. And the team that we have with Oz and Bobby and Chris and all of the people that we had working on it. And I must tell you, Marty's been a big, wherever you may be, Marty, but Marty's been a big factor. We have a great team. There's never been a medical team like this. And I said, let's go do it. And then I did, as I said, I would bug them every single day, every week, because I said, we have to have, I mean, why should we be paying 10 times what another country is paying? And that was just an excuse, you know, research and development. We do research and development. So now we're going to be paying whatever the lowest price is, we're going to be paying that price. So it's a great thing. But there won't be anything that can have the impact on Medicare, Medicaid, Social Security, anything where you need pharmaceuticals, medicines. The numbers are going to come way down. Even Obamacare, which is terrible, it's not been good, as you know. It's a weak form of health care. But it'll be better because the medicine's going to come in at a very low price. Yes, please.
Yes, Mr. President. It seems like every time you assemble your MAHA team and your cabinet members behind you in regards to health issues, it just keeps getting powerful. And I look at these young kids there and the weight that is on the world right now that you can lift by what you're doing. I've often said Trump could cure cancer and people would still criticize him.
That's true.
And it's true. What is your message to America that this potentially could bring us all together, get us on the same page and have unity? And I'd like to see if some of the kids or the parents have what it means to you to see President Trump get involved with this.
Well, we've made tremendous strides in cancer research, far more than anyone has done. And we have the greatest minds, the greatest people working on it. And
all right, you're taking a look right now at President Trump in the Oval Office. You continue to monitor his comments, and we will bring you any breaking news out of that as soon as we get them. And just a reminder, you can continue to view Trump's comments by typing LiveGo on the Bloomberg terminal. Meanwhile, we do want to go to a conversation about the future of AI and the future of consulting. I had a chance to sit down exclusively with McKinsey's global managing partner, Bob Sternfels, earlier today. And he talked about what really his clients are keeping an eye on. Here's a portion of that conversation.
You know, one of the things that I've learned is this journey on continuing to find best talent and diversify that is one that you never really get there on. Mm-hmm. And so when you pull back, it's great to pick individual marks. But in the last 4 years, we've doubled the number of women partners in McKinsey. Mm-hmm. We've reached parity for the first time in our inbound hiring. And we're taking our own medicine, and you've seen some of this from the work we've published, to identify where the broken rung moves. Mm-hmm. You know, now we're focused on sponsorship in the middle tenure years to ensure that you have disproportionate odds of success going forward. And everybody should have sponsorship, by the way. But we're really focused in on that to ensure that we don't slip back or lose ground. So we're accelerating around our advancement in women, but I think we could do more. I think we could go faster.
Overall, with regards to your total employee count, are you still looking to trim headcount, or are you adding?
You know, we've always been adding, right? Despite what you read. McKinsey's made up of two sets of folks. We have some folks that you probably are thinking about, which are are client deployed people that go out to our clients. They live there, most of the week and help drive the change that's enabled. And that's about half of our population. The other half provide support to those folks, usually from remote locations. And we have two different things going on at the same time. We're continuing to add folks who are client deployed, and we see an ever increasing need of that, and we're aggressively in the market right now looking to expand that. But we are rethinking our center-based operations by leveraging all of this new technology. And my suspicion is going forward, we will continue to look to ways to change that model, and that we will upskill folks more. We'll probably have fewer folks in the non-client deployed areas, but they will be leveraged by today's technology and AI. And that's what you see going on around us, where we've figured out a way to continue to grow this body, but we're looking to optimize this body. And so I think we can do both at the same time.
How have you employed AI and some of these new technologies so far? And I mean that more so, not just on what's going on in the back office, if you will, but also for the client-facing employees.
Well, I'd maybe start with the client. And so let's start with what's going on in enterprise, both in America and around the world. And, I think we are facing almost a gold rush type of mentality about the pace and scale of technological change that we're seeing around us. Things are moving really fast. And I do think that there's wonderful promise associated with this. But it's going to be hard to get there. And I think we're not talking yet enough about how hard it is to really change enterprise, to rewire enterprise, to realize the value from this new technology. And so what we're seeing in our own proprietary research is no different than some of the other public reports around this. Enterprise spend on technology is up, but real value delivery is yet to be had. And when you get to that, some of the underlying causes are, you got to think about domain-specific applications around this. And what matters in a bank is different than what matters in a semiconductor company. Got to think about changing the org model. What does the org model look like in 5 years' time? And what does that mean for the skills profile as you think about the skills that employees need to be able to leverage this technology? So that's going on in our clients. It's no different than in ourselves. We're a 40,000 person organization spread across the globe, and what we're finding is, one, how do we think about the highest application areas? And I mentioned our knowledge centers are one of the biggest areas that we're applying this technology. But how do we also arm those client-facing consultants with tools that make them, I like to call it, make you superhuman, not superfluous? And because I often get asked, and maybe you'll get to this, I get asked by a new young hire, is AI going to take my job? Right? Is this going to work me out of a job? And I say, well, it depends. If you define your job as it is today, probably. Right? But if you use this as a moment to figure out what are all the things that AI can do, and then you use the time that is freed up to go help solve even more complicated problems with the client, no. Because this is a belief that, look, there'll always be something more complicated. There'll always be something more aspirational that our clients want to tackle. And so we're on this race to figure out, how do you redesign work as you arm people with these new and amazing tools?
How much is this discussion of AI dominating the requests that you're getting from clients for help right now?
If I looked at the two biggest topics worldwide, and it varies based on where you are in the world, you've got a great appreciation for this, but the two biggest ones are technology writ large, which AI is at the center, but I widen it to technology. That's about 40% of the work that we're doing right now worldwide. I'd say quickly followed with, in some way, shape, or form, how do I make my organization more resilient, given everything that's going on in the world? And a belief that resilience is going to matter because I will withstand future shocks. So I need to innovate with this technology, but I need to make myself resilient at the same time, Can you help me with both of those?
Are clients generally constructive about current conditions right now, not just here in the United States, but around the globe? I mean, there's been a lot of geopolitical shocks, obviously a lot when it comes to various policies coming out of the U.S. government as well as Europe and now over in Asia. Are they comfortable with where we're going?
You know, I think the role of a CEO is not necessarily to ever be comfortable and in any context. And, you know, and if you're an investor and you find a really comfortable CEO, that may tell you something, right? You know, and so there is this idea, I think, a role of a CEO is at one point is to be aspirational. How do you set an aspiration for change? And back to the technology point, I think you do see a lot of excitement that although it may be hard, the potential for these new technologies to transform who I am exists. Drug discovery, you know, radically shortening the cycle times, amazing customer experience, you name it, right? But on the other, that the world is getting to be a more volatile place on any dimension. You talk about a bit of government policy, but it's not the only variable in this. How are the economies performing, the role of government, you know, demographic change that you haven't dealt with, you kind of name it. And so a belief that I need to change my organization model to be able to do two things at the same time. And I like sports, right? I can't just play defense. If I just play defense, I'll be able to withstand the shocks, but I'll come out average. I can't just play offense. So if I play offense, I might win, but I might blow myself up. So how do I play offense and defense at the same time with a recognition that I'm going to have more things thrown at me going forward as a matter of course, that things won't go back to normal, that we're in a new normal now.
It's
and
a
how
new
do I
normal.
navigate through this?
It's also a bit of a chaotic normal, and I'm wondering if that's actually helped McKinsey's business.
You know, the first thing I would say is I think that idea of more chaotic depends on where in the world you sit. You know, if you talk with CEOs in Brazil, they might say, to your point, it's been chaotic for a long time, and we just have the muscle to navigate through, whether it's inflation, whether it's a pandemic, et cetera. Like, this is the normal of operating as a CEO in Brazil. I think it is a bit different operating in the US and in Europe. And so that idea of more volatility going forward, I think, is now sinking home in some of the largest economies. You know, it's lonely, I think, particularly as a CEO right now, on how do you navigate through this, because you have a lot of different stakeholders. You might have a board that is really focused on, are you sure you're doing everything you can to protect the institution? You might have employees that say, what's the security for me? You have a different interaction with governments around the world, and their involvement or not with your business has changed. You have technology providers saying that, are you really moving fast enough on this technology? And then you have this belief of, look, I was brought here as CEO for a reason, which was to lead us in a way that is going to differentiate myself from my competition.
And that was part of my conversation with Bob Sternfels, Katie, who, of course, leads the consulting giant McKinsey as the global managing partner there. Obviously, they're going through a lot internally, but he talked a lot about AI, not only what his clients are looking for with AI, but also how he reshapes what's going on internally using that technology.
Yeah, absolutely. I mean, you think about AI from where he's sitting at McKinsey, talking to his clients. I have to imagine the CEOs that he's in regular conversation with, that's at the top of the list.
And of course, another big aspect of the big AI boom has actually been, well, the demand, the insatiable demand for energy to drive it all. There's been a lot of discussion here about how you balance out this boom, which is, of course, creating jobs and opportunities, but also raising the price, a wholesale price of electricity, and of course, what people pay when they get their bills. That is the Bloomberg Big Take today, and I'm pleased joining us right now to talk a little bit more about this is the Secretary of Energy for the United States, Chris Wright, who's out in Long Island, New York, to talk a little bit more here about how we find that balance, Chris, between these data centers and these other sort of energy-hungry businesses, and at the same time make sure that people who are just trying to power their homes also have affordable and reliable energy as well. What progress are you making?
Romaine, you laid out the right issue. You know, the key thing is to stop the rise of electricity prices. About 25% rise during the Biden administration. President Trump got elected in large part to stop that crazy rise in electricity prices and to enable the growth in electricity supply, as you said, to power data centers. We can't have it as a trade-off. We want to use development of the electricity grid for data centers as a way to ultimately drive down electricity prices for consumers across our country. That takes some time. We need to build new infrastructure. We need to add new power plants, make our grid smarter. But that's what President Trump got elected, to move fast and move decisively against the dangerous direction we were on that was towards blackouts and more price rises. But it can be done. There was a deal, let me just give one example. There was a deal done in Georgia between Georgia Power and Light and Google, a large data center deal, but the net result of that was Georgia Power and Light agreed to freeze their electricity rates for the next 3 years. We can get both. We can bring the power to data centers and stop the craziness in electricity prices. It's a challenge, but it can be done.
I am curious about how we do this, and more importantly, what the timetable is. When we talk about infrastructure improvements, as you just point out, that's not something you can just, flip a switch, pun intended, and sort of have that show up tomorrow. What is the timetable where you can then start going into these communities and saying that, okay, the infrastructure is now in place, or at least is on its way to being in place?
Well, one is we can stop shutting down existing reliable electric generating capacity. You know, when I took office, there was slated to be 100 gigawatts of coal and natural gas power plants closed in the next 5 years. First of all, we can stop doing that. If you want to build a mountain, you got to stop digging the hole first. That's immediate. You know, we kept open a coal plant in Michigan a few months ago. We took a lot of flack for that. There was a brownout in the area a few days later. That plant ran hard all summer long. Thank God that capacity is still there today. So we'll see a lot more of that, a lot of plants that won't be closed. Then we got to be smart with our existing assets. There's backup generators on all sorts of data centers and other large facilities that right now, through just some crazy rules, they only can run if the power grid fails. No, we want them to run when demand is high and prices of electricity are going up. Let's turn those assets on to prevent blackouts, drive down peak power prices. We're going to do smarter things about transmission lines to move electricity better. And of course, we're going to stop subsidizing unreliable, weather-dependent power sources that ultimately are the source of the rise to begin with. We'll still see additions of those, of course, because there's a lot in the pipeline. But we're at least going to stop the subsidy, stop paying people to give us the benefit of more expensive electricity. We lost twice on that one.
Well, when it comes to the cost of electricity, there's a great Bloomberg News article today about how you take a look at Data Center Alley. That's a region in Virginia, of course, that electricity bills for residents have just skyrocketed over the past couple years. And I wonder, from where you're sitting, is your department looking at rules here to make sure that some of these resource demands and these costs aren't ultimately shifted onto residents of these areas?
No, you're so right. There's plenty of examples like that that are deeply unfortunate. We are talking to all of the hyperscalers, all of the data center developers, and just communicating to them. If you drive up electricity prices, no one will want AI, no one will want development in their communities. We need to make this a win for America by leading in AI and a win for communities by stopping the price rises. Yeah, it hasn't gone smoothly so far historically. President Trump's only been in office for a few months, but you're right. There's dialogues. You will see some regulatory changes in FERC as well. This plan will continue to roll out. But boy, you're hitting the nail on the head. That's exactly what we work 7 days a week on. How do we stop the rise of electricity prices and enable AI and allow America to reindustrialize? Faster permitting of power plants, stopping the closing of power plants, more sensible rules around grid regulation, and some special things that allow us to get capacity out of existing assets. I mentioned backup generators, also increasing output from existing assets. Yeah. A lot of stuff that we can do quick. And some of it's going to take, and some of it, building new assets, of course, is critically important. But you're so right, that takes a few years. But we got to get the shovels in the ground and get it underway.
Well, Secretary, I want to switch gears a little bit here because there was reporting last week that the Trump administration is seeking an equity stake in Lithium Americas. Of course, it's in discussions with the Energy Department to renegotiate some loans. But can you give us an update on those negotiations and the potential equity stake?
Oh, I sure can. So look, out in northwest Nevada, there's an amazing lithium deposit, the biggest lithium deposit in North America, by far the biggest deposit in the United States. And there's a mine under development there. A small company, Lithium Americas and General Motors. They want to bring domestic lithium is produced in the United States. China has controlled that market for mining and for processing, and they can control the price up and down. They can shut off supply to the United States and hold us hostage to them. We can't tolerate that anymore. But China, of course, has driven down the prices of lithium, so the economics of that mine looked much more challenging, but yet it's in America's best interest to get that mine built. So what we did was a creative deal, engaged with GM and Lithium Americas to find a way to bring more capital, equity capital, into the mine. Yes, for us to take an equity stake in the mine and to do those things so the mine's going to be viable, economically sound. It's not going to be the next Solyndra. And then we can advance the loan capital that'll help that mine get finished. Super proud of the deal and negotiation that happened there.
Yeah.
We're going to see a huge new lithium resource come on in the next couple of years that'll displace a massive amount of imported lithium, not just the lithium, but the processing of it right there in Nevada.
I'm sorry, Chris, maybe I misheard, but what is the stake that the government is going to end up having once this deal is complete?
So the government will take both a 5% stake in the company, Lithium American Corporation, and also a 5% stake directly in the mine. That's a JV between Lithium Americas and General Motors. Mm-hmm. So we'll own at the mine itself and in the developer and in the corporate entity that is the developer of the mine. And this is just economic common sense. Lithium Americas needs to raise some more capital so the mine be financially sound. We're leaning in with a large amount of debt capital. So it's just a more commercial transaction where we're making sure lithium is going to be mined and refined in the United States, but we're treating the American taxpayers' money with respect.
With regards to the existing loan that they had out there with the Energy Department, so I assume this would be a renegotiation of that, or it would resolve that loan in some way or another. What is then, with regards to that stake, both in the JV and in Lithium Americas itself, is there sort of an exit strategy, or is the idea that the government would just basically maintain that stake in perpetuity as long as they saw fit?
No, there'll be an exit strategy there. That's not that we want the government holding permanent stakes in companies or in mines. It's just doing a commercial transaction under reasonable terms. There was a loan commitment, not a loan before, a loan commitment, but of course all loan agreements have conditions, and the biggest condition is just to make sure the mine is economically viable. And with the decline in lithium prices, we needed to just change the conditions a little bit so the mine was economically viable. That means Lithium America raising more capital to go into the mine itself, more equity capital. And it meant with the taxpayers taking a little bit of risk on this loan to get equity upside in the project. But it's not a permanent stake. As the mine gets done and things come into commercial operation, we will seek to exit those positions.
All right, Secretary, we really appreciate your time. That is United States Energy Secretary Chris Wright. Meanwhile, the government shutdown looming, with Congress still in the throes of debate. Let's dive deeper into what this means for the U.S. economy and looming deficit concerns. Joining us now in studio, I'm pleased to say we have Natasha Sarin. She is the president and co-founder of Yale University's Budget Lab. Great to see you in person, Natasha.
So happy to be here. Thanks for having me.
So let's talk about the economic consequences here, because when you talk about the shutdown in the context of the financial markets, a lot of investors and analysts tell us not to worry about it. But when it comes to the actual GDP impact and other matters, what does even a short shutdown mean?
So a sort of general shutdown, it's always struck me, by the way, as so strange as an economist that, like, this is the way that we fund the government. Because imagine if corporations funded themselves this way, that every year they wouldn't know whether they would be able to keep workers on staff that they had hired previously because they wouldn't know what types of funding sources would be in place. So it's like a weird way to run a rodeo, but it's the way we run our rodeo. And so regularly scheduled, we have these conversations about shutdowns and their potential impacts. And we know that there's a whole slate of disruptions that happen even in normal shutdowns. So it's stuff like people are not going to be able to, they've planned trips to national parks or museums and aren't going to be able to take those trips. And so the follow-on effects of the lack of economic activity that you're not going to see as a result of that is going to spill over. You also know that workers are going to be furloughed, and even those who are asked to maintain and continue in their roles are going to not be able to see paychecks for the work that they're doing over the course of the shutdown period, and we know that that's disruptive. But we also know that we're in almost sort of more disruptive than normal times with respect to a shutdown.
Yeah.
Because we're seeing the administration say that they're kind of using this as a moment to try to cut the size of the government writ large, which is going to have longer term repercussions.
Well, that's what I'm curious about too. I mean, having covered several shutdowns in the past, there was always this sense of certainty. The idea that it was going to be temporary, the idea that if you were furloughed, you were still going to get your pay. This seems a little bit different, at least if you believe the rhetoric that we've heard out of that. How do you sort of quantify the potential impact of actually people either losing their jobs or, more importantly, at least just losing the pay for whatever stretch of time that the government is gone?
And it's losing those jobs, but it's also, again, if you're listening to some of what we're hearing, it's also programs writ large or benefit programs writ large being scaled back as a result of the shutdown, almost providing an impetus to do that kind of work. And so part of what I worry about is, if you're thinking about this from a market's perspective, obviously there are like real human impacts there to those workers who aren't going to see those paychecks or aren't going to see those benefits. But if you're thinking about it from a market's perspective, part of what has made the United States such a remarkable place to invest is the stability of the belief in the stability of our debt and our ability to make good on our payments, the stability of things like the rule of law in this country. And so all of this is coming at a time when that stability feels like it's questioned in deep ways.
It's questioned in deep ways, but also on this issue of the shutdown, when we talk about agencies that are going to be either shut or basically operating on the skeleton staff, we've been talking on the show all last couple of months about this huge opening in the IPO market. That basically comes to a halt. I mean, you go from 4,000 employees down to 400. If you've got an IPO on tap right now, that's not happening. So is that just a deferred IPO, or is it just going to get pulled all together?
I hope for the sake of, I hope that what we are going to see in some sense is, if you look at the prediction markets, they're predicting with like 86% likelihood we're going to see ourselves shut down over the course of the next few hours. I hope that we're in sort of normal time shutdown if that case occurs, such that this is a temporary thing. But I think what you're pointing to, Romaine, is like very deeply important, because even on Friday, we are supposed to be getting a jobs report that is going to tell us, in a time of like deep uncertainty about the state of the labor market or what's happening with tariffs and how it's weighing on hiring decisions that firms are making, we're supposed to get this indicator coming out of the Bureau of Labor Statistics that can help industry, that can help policymakers make decisions about what types of policies they're looking to pursue. And we're not going to get that on Friday if we're in the midst of a shutdown. And again, I hope this is temporary, but I think these have long-lasting consequences.
Yeah, and we are, of course, laser-focused on that labor market data. Maybe increases the scrutiny on ADP, that print coming tomorrow. But we know that the correlation between ADP and NFP is fuzzy at best. But when we talk about the effects of a shutdown, as we get deeper into it, as we go from days to potentially weeks, how do those effects multiply? Is it linear, or are we talking about parabolic?
You know, I hope that we don't get ourselves into a case where we're having to analyze the possible parabolic impacts of the shutdown on the economy. But I think the answer, honestly, is that we don't quite know. To your point before, what investors and industry experts are telling you is kind of like, shutdown, don't worry about it. But what I worry about when I hear that is they're thinking about the types of shutdowns that you've spent your careers covering, where you weren't talking about long-term disruptions to the way that the government functions or the types of benefit programs that exist or the federal workforce writ large. And so I just think we're in kind of dangerous, uncharted times, and it's too soon to tell, and I hope we don't get there with respect to some of those potential repercussions.
Natasha Sarin is the president and co-founder of Yale's Budget Lab. We should point out here at almost 5 p.m. here in New York City. Katie Greifeld, 5 p.m. in Washington, just hours away from a government shutdown should the Democrats and Republicans in the Senate find some modicum of compromise.
Yeah, just about 7 hours to go here, and we'll see if we get over the line. I'm sure you'll be waiting up to see the results if we do have a vote. We do have a lot to look forward to tomorrow.
I just want to point out, too, and we should point out Joe Matthew and his team, they're going to have special coverage of this, staying on top of this all night as we hope for maybe a potential vote in the Senate. But if we don't get one, we know where we go next.
Yeah, it certainly seems like both sides here are digging in. I mean, I think back to our conversation with Tom Emmer just about an hour ago. It doesn't seem like there's a lot of olive branches being thrown around.
All right, well, that does it for us on the close. We should also want to reiterate that news news there also about the U.S. government taking a stake in Lithium Americas. But keep an eye on Washington. Coming up at the top of the hour, special coverage of the showdown to the shutdown.